There is a lot happening on global front, a lot of cues to watch out for. Earnings season is going on in full swing. So let's take all the discussion forward on those front with a guest who is coming back on the channel and on my show after a hiatus, and that's Manish Sonthalia. He is the CIO at Emkay Investment Managers now. Manish, good to see you back on the channel in your new innings. Congratulations and best wishes for your new innings once again.
Thanks.
Before I talk about themes you are focusing on, I want to understand the construct. How are you analyzing the construct of the market right now? There was a bit of a scare, 18,850, when we had fallen to mid of next week, but that correction resulted in a very shallow, swift move, and then we are back. Especially mid caps have rebounded very sharply. What are the key points you're observing to make your construct right now?
So I think on the market front, we are broadly going to be in a sideways market between now and the next, till March 24, I would believe. Many reasons for this sort of stance is basically your dollar index is closer to all-time highs. The Middle East problem can flare oil. Inflation remains a worry. Interest rates would still be rising, at least in the US. And if US was to move up and oil is a problem, then interest rates are likely to move up in India also. We have seen a good rally as far as the broader markets are concerned. There is a tighter liquidity environment currently in our country as well. So I think all of this translates into the fact that we'll broadly be, let's say, between 18.5 and 20,200, the previous highs that we crossed. Markets are really not going anywhere in a hurry. It's going to be pick and choose market for all that you know. But it's a very good time to create a portfolio for the medium term. I think post central elections in 2024, and obviously the long term, it's a golden decade of India. I reiterate my stance. So that's how I would look at it. Large caps have more value currently than mid and small caps. They should ideally be trading at a discount to the large cap. Probably they are trading at a premium, 25% sort of a premium to large caps, which historically has never stood justified. So that's how I would place the entire situation currently.
Manish, your portfolio, which you have curated, a mix of large cap, mid cap, what kind of earnings visibility do you have on your portfolio? I want to get a flavor that if one really, carefully crafts a portfolio, what kind of earnings can be reflected next 2-3 years?
18 to 24% compounded growth rate in profits for a 25 stock portfolio. Vis-a-vis market earnings growth historically has been around 15%. I mean, that has always been my thesis. And even for the new portfolio that I'm creating out here, it would be broadly the same. So I would look to buy or, look to discover companies which can be doubling their profits in 3 to 4 years, that is to say 18 to 24% compounded. And these would be broadly from structural themes in India's context as opposed to deep cyclicals. I mean, that is one caveat that I want to say. That we don't want to buy significant cyclicals, so to speak. There is a cyclicality which is available in all businesses, but deep cyclicals is something which we will avoid.
We are aware of your earlier portfolio as well and your stance. Are you making a completely new portfolio, or there are some overlaps as well?
You could have at best 5 stocks which could be overlapping in a 25 stock out portfolio, but it's broadly going to be 35, 1/3 stocks would be large caps and 2/3 would be mid and small caps. So obviously we want to create the next big winners between now and 2030, and that's the endeavor.
Okay, sure. Let's talk about some of the themes which you like, because you're making a very valid point. 6 to 8 months market could be listless because there are big triggers. One would want to be on the side till those triggers get played out, and then money will start coming in. So in the meantime, take your time out, research and identify names at least. Then you are making a case for good kind of a decadal move, 7-8 years of decadal move. So out of the e-commerce company, or I'll say consumer tech, they have rebound quite sharply. Is there any theme within that which you like, which is appearing more structural now that the management focus is back on profitability?
Within the consumer tech space and in the listed space, whatever we know, I mean, I'm extremely bullish on Zomato, and we own it in our portfolios out here as well, and even in the previous organization. So I think Zomato from here can double easily. I think their right to win has got established. The total addressable market size is huge. It's a direct play on per capita income growth in the country, which could be anywhere between $5 and $7 trillion between now and 2030. And I think the unit economics for food deliveries got established. Of course, this quarter has not been so great for consumer companies per se. So it may be a great time to add these sort of franchise going into the next many years. And Blinkit is still an optional play which would break even very soon, and obviously EBITDA positive. I think 170 crore, 140 crore orders between Zomato and Swiggy going up to, let's say, 300 crore orders in the next 3 years is very much doable. And that would translate into a 24% sort of a order growth, number of order growth, plus then we are talking about increase in contribution from 20 to 23 rupees per order, going up to something like 27, 28, or even 40 rupees, as some people are opining, but we building in something like 27, 28. I mean, that could translate it into a humongous amount of profit growth, and the market cap can't stay at around a lakh crores, given these sort of unit metrics. So I would believe a 2-3 lakh crore sort of a market cap is very much possible on Zomato, and they have established the right to win. I'm not so optimistic on the other consumer tech companies which have not yet established their right to win. So the likes of Nike or anything. But this is one name that we are extremely positive on.
Manish, anything else which you have researched on lately as a theme? Something which may be an ancillary play to some of the very fast growing categories in the consumer side. It could be beverages, it could be premium alcohol, it could be. So there are so many categories in the consumer space which is showing very high growth. Are you playing it
Retail,
directly, indirectly?
retail. I mean, retail is huge in India. I mean, I was just reading some numbers, some $800 billion of food and beverage market in India annually, out of which $700 billion in the unorganized space, $100 billion packaged business, out of that $800 billion, of which 40 billion is branded. Now, this is the size of the opportunity which is out here. So, if you look at just retailing between now and 2030, and the way consumption is happening in retailing, I mean, it's a generation shift between Gen X and Gen Z, the millennials way of shopping vis-a-vis the Gen X way of shopping, the brick and mortar way of shopping. I mean, it's a different ball game altogether. So the growth rates in any form of retailing, whether it is your apparel, whether it's food, if you get your unit economics right, I mean, unit economics actually means that it should be, your store level ROC should be greater than your cost of capital, and you should be able to grow and increase your area under sales consistently. And obviously, that is a number which I would look at anywhere between 18 and 24% CAGR for many years to come. And
Just
if it is so present in the D2C category, even better. It's an icing on the cake. So retailing in any form could be Manyavar, it could be
a
Trend, and so on
one
and so
quick
forth.
follow up out there, Manish. So packaging is one area which is called also ancillary of food and beverage sector in the consumer space. There are two sides to it. One is the glass packaging, glass containers and all. There is plastic packaging as well, and both are witnessing good growth. So which side would you tilt on? There are very few companies in the glass packaging side. Then plastic packaging there are quite a few in the unorganized side as well.
No, so given the regulations now, that is, withdrawal of non-degradable or non-biodegradable plastics in the country, and the shift away from plastic to paper, and the growth of consumption, whether it be the FMCG category or the food delivery, food service, etc. I mean, anybody catering to the paper side of packaging is a huge runaway, and you have some few examples where the runaway has been stupendous. a few of them, but they have a right to win, and they have a very deep moat because the customer attachment of the lock is for real. You don't shift your vendors very easily, whether it be tobacco, cigarette boxes, or whether it be your shampoo bottles or sachets, and so on and so forth. Now come to, let's say, glass packaging. Again, whether it be FMCG, whether it be liquor, and then to within that the premiumization story. And mind you, few of them can actually see a more than 40 to 50% market share. And these companies available for less than $1 billion. I mean, they have a huge run and trading in maybe single digit, high single digit sort of a P growing at something like 20% or 15 to 20%. I think there's a deep value. So some of these names do look very exciting. It's a directly on consumption, and packaging will play a very important role because again, it's a generational shift. Looks and aesthetics do matter a lot. And all these consumer companies will pay a lot of focus on these aspects as well.
Outstanding answer, I must say. One last query I have with you regarding pharma. Now, while the big generic exporting pharma companies are also saying that growth is back in US and their target markets because of easier compliance, or relatively easier compliance and growth coming back, it is the domestic pharma which is actually raking it in terms of growth and margins, and there's a lot of stuff happening on the domestic pharma side. And do you like this theme better than export play? And if yes, so what's the kind of expectation on earnings growth?
So let's wind back the clock. And as far as the pharma story is concerned, these companies were growing in a normal trajectory till about COVID, which broke in March 2020. And then it was an accelerated growth for the entire pharma space, which actually brought in a lot of supply through capacity buildup and new product approvals. And all of this happened thick and fast. And since the entire sector didn't know as to how long this this COVID was going to last, I mean, they just kept piling on. And because of supply chain disruptions, the stockists and the distributors do piled on a lot of stocks. Then COVID ended on a very high base. When COVID normalized, you actually saw destocking. So this is a classic case of stocking and destocking. Now we are in a normalization phase. So I would build that growth is actually going to come for both the domestic pharma companies as well as the generic exporters. The pricing pressure problems and the US FDA issues, of course, the peak of that we have already seen. It's not going to be a sloping trajectory on the downside, both on the pricing side. You're not going to see that sharper depreciation from these levels because many things have now approached the shutdown point. If you are not able to make ROCs on generic exports, you better withdraw from the market. It's come to that on a global supply basis. I don't see too much of pressure on generic exports. The pricing pressure that was there. US FDA issues are broadly sorted out. There will be specific issues on companies, but on a general basis, that's not going to be there. And obviously, normal trajectory on growth on a very low base. Stocking and destocking, which means now that the base is very low. On a very low base, both the domestic and the generic exports as a whole, it will be about pick and choose of individual stocks where the valuation comfort is there. But you have many companies where, dividend payout ratios of 40% of profits, the margins are going to move from, let's say, 16, 17% to the historical level margins have been north of 25%. I mean, you have ample stories out here. So from that point of view, I think there is huge margin of safety in the pharma stocks vis-a-vis many of the sectors which are trading at ridiculous valuations.
Manish, always so educative talking to you. Thank you so much for your time today as well.
Please. Thanks a lot.
That was Manish Sonthalia, CIO at Emkay Investment Advisors. In his new role, earlier, of course, he was with Motilal.